you divide those two things. If you have less than 1 as your results, so if you divide current assets by current liabilities, and you have a number that's less than 1, that means that your business is in a cash flow crunch. You do not have enough liquidity to service your assets, or you don't have enough current assets to service your current liabilities within the given year's period of time. You're going to have to make some adjustments to how you're spending money, maybe stretching out your payables and receivables like we talked in the last episode. You're going to have to make some operational changes to bring your current ratio above 1. 1 or above is good because that means that you have enough money to fund your activities for the year or in the current ongoing business operation. But you want to be higher, as much above 1 as possible. If you get too far above 1, then you just have too much cash laying around, and we should probably put that to work. So there is some art and some science to managing your current ratio, but every business owner needs to be looking at this on a regular basis. This is a very important one. And actually, if you take that current ratio and you convert it to dollars instead of a factor, that's going to give you your working capital, which is what we talked about on the last episode. So that becomes helpful for you to know as well. And then the last one I'll give you real quick, average days to collect revenue. This is a very important number because this goes into, again, the last conversation when we're talking about how to properly structure and improve working capital. Part of that is in how many days does it take you to collect revenue and how many days does it take you to pay your bills, and how can you make a little bit of arbitrage between those two to be efficient for yourself. And so all you do there is you take your sales number and you divide it by a factor of your accounts receivable divided by 365. And your accounts receivable is going to show up on your balance sheet. Your total sales is going to show up on your P&L, and that's a very easy calculation to do. But this is a very important calculation to do because if you find that your invoice terms are net 20 to your clients or customers, and your average days of collection are higher than that, then you have a problem with collections. You have a problem with people paying you on time. And so then you need to address that with your clients, with your salespeople, with your operations team, with your finance team. Maybe you need to have somebody who is calling on past due invoices. And that can be a very telling number. If you find that